How to mitigate overfitting in algorithmic trading. In the dynamic world of algorithmic trading, where milliseconds can make the difference between profit and loss, the risk of overfitting looms large. Overfitting occurs when a trading algorithm is tailored too closely to past market data, resulting in poor performance in real-world trading scenarios. Mitigating overfitting is crucial for algorithmic traders to ensure their strategies remain effective and profitable over time. In this comprehensive guide, I'll explore 3 key strategies to mitigate overfitting in algorithmic trading, accompanied by real-world examples. Use out-of-sample data. One of the most effective ways to mitigate overfitting is by using out-of-sample data for testing. This involves reserving a portion of your data specifically for testing purposes, separate from the data used to train your algorithm. By testing your algorithm on data that it hasn't seen during the training process, you can better evaluate its performance and generalization capabilities. Example: let's say you're developing a machine learning-based trading algorithm that predicts stock prices based on various technical indicators. Instead of training the algorithm on historical data spanning from 2010 to 2020, you decide to reserve the data from 2018 to 2020 for testing purposes. By evaluating the algorithm's performance on this out-of-sample data, you can assess its ability to generalize to new market conditions. Simplify your model. Complex models are more prone to overfitting, as they have a higher capacity to memorize noise in the training data rather than capturing underlying patterns. To mitigate overfitting, prioritize simplicity over complexity in your algorithmic models. This involves using fewer features, reducing the number of parameters, and employing simpler algorithms whenever possible. Example: consider a trading algorithm that uses a deep learning neural network with multiple hidden layers to predict stock prices. While deep learning models are powerful, they are also highly complex and susceptible to overfitting, especially when trained on limited data. Instead, you decide to simplify the model by using a linear regression or decision tree algorithm, which are less prone to overfitting and easier to interpret. Regularly update strategies. The financial markets are constantly evolving, influenced by a myriad of factors such as economic indicators, geopolitical events, and technological advancements. To mitigate overfitting, it's essential to regularly update your trading strategies to adapt to changing market conditions. This involves re-evaluating your algorithms, incorporating new data, and adjusting parameters as needed. Example: suppose you've developed a mean reversion trading strategy based on historical price data and technical indicators. However, you notice that the strategy's performance has been deteriorating over time, possibly due to changes in market dynamics or increased competition from other traders. To mitigate overfitting, you decide to update the strategy by incorporating alternative data sources such as sentiment analysis or news sentiment, allowing the algorithm to adapt to evolving market conditions. In conclusion, mitigating overfitting is essential for algorithmic traders to ensure the robustness and effectiveness of their trading strategies. By using out-of-sample data for testing, simplifying models, and regularly updating strategies, traders can minimize the risk of overfitting and enhance the performance of their algorithms in real-world trading environments. Remember, in the ever-changing landscape of algorithmic trading, adaptability and simplicity are key to long-term success. Happy trading!